Welcome to the Capital News. I am your host, Alex Karitis. Thank you so much for joining me today. It is March 22nd, 2019. Whoa, Nelly! The stock markets took a big hit today. And there was a lot of other breaking news politically, too, so a lot of this stuff is going to be intertwined, as it always is. So let's get into it. The S&P was down 54 points, or 1.9%. The Dow Jones Industrial Average was down 460 points, or 1.7%. The NASDAQ was down 196 points, or 2.5%. And the Russell 2000, the small cap index, was down 56 points, or get this, 3.6% on the day. That is a huge hit across the board. We're going to get into the reasons why this happened. But, I mean, what is going on here? Ever since Wednesday, and Jay Powell came out and gave his press conference, we had the market go down on Wednesday following the news of a more dovish Fed. Then on Thursday, it recovered. And now today, Friday, my goodness, what is going on? Well, maybe they're listening to this podcast. Maybe. I hope that's the case. And things are starting to become real again. Can we make the markets real again? Can I make a hat? Can we do this? Can that be a campaign slogan? Make the markets real again. Because if you're working off of the notion that there's actually real information and you have a stock market, in all financial markets for that matter, joined together with its underlying economy, then we should know where things are headed. Instead of being in a rigged system, in a market upon market that is in a bubble upon a bubble and a bigger bubble. Can we just get real here for a second? It's all it takes. Once this happens, this is going to be one of the biggest days of reckoning ever. Ever. Mark my words. March 22nd, 2019. This does not mean that this is going to happen next week, but it is coming. Mark it down. Mark it down and prepare yourself one way or the other. I don't care if it's through gold. I don't care if it's getting into cash. I don't care. I mean, you have to be careful. Whatever you're doing, you have to be careful because this market is so fixed. It's so rigged. It's so headline-driven. I mean, you watch some of the financial news today. It's, well, some of the growth, the global growth concerns are back in the headlines. What do you mean back? Where did they go? They never should have left. They never should have left. You cannot base an economy. You cannot base policy. You cannot base an economy off of hope. You can't do it. It's fruitless. It's ridiculous. We're better than this. We don't have to base our economy off of hope. We have an entrepreneurial spirit in this country. What we also have is a government that's just too damn big that saps everything and just squashes everything. And you have a government that's joined at the hip with big business. And so it keeps down the little guy. And then you got the lunatics on Constitution Avenue at the Federal Reserve printing funny money for over a decade, giving it to their crony pals. And now you have income inequality the likes the world has never seen, the world over. So is it any wonder why we have a growing populist movement all around the world? Not just in the United States, everywhere. We saw it with the Brexit. We saw it with the election of Donald Trump. We see it with the yellow vests in France, which continue to riot, by the way, and they're getting more violent. I don't like the violence, but that's where they're going. That's the direction it's going. All over the world, this is taking place. All over the place. People are fed up with it, and they should be. And they should be. Oil, it's down $1, but it's still lingering. It's right around $59. Not a huge hit. Gold was up a little bit. Nothing to write home about. Silver was little moved. The dollar, that whipsawed back and forth depending on the currency, but it took another hit today. But get this, and here's really one of the important points. The 10-year bond now sits at 2.455%. 2.455%. That is down 3 percentage points on the day. That is a huge move. Remember, we were just talking yesterday about how it was moving 2.6, 2.5, 2.55. Now it's below 2.5. Now it's at 2.45. What is going on here? We have a continuation of the yield curve making its inversion, especially in regards to the 10-year and the 3-month. That's huge. That is huge, and we're going to talk about that in a little bit. Then we have the VIX. The volatility index was up a whopping 21 percentage points today on the day, and now sits at 16.5 points. So it's all over the place. It is all over the place. So if we're going to talk here about the yield curve, because that's now front and center, because we have not seen this since 2007. And what was 2007? It was right before 08 and 09, the Great Recession. Why? Because the yield curve, once it inverts, it is a great forward indicator that predicts an oncoming recession. This is what I've been talking to you guys about for the past couple of days, and the markets know this. It's predicted the last 7 recessions accurately. Again, it's not tomorrow. It might not be next week. It might not even be next month, but it's coming. That's what it means. It just simply means that there is more near-term risks, and as a consequence of that, you have people looking for safety. You have people looking for safety. And they get into shorter-term safe haven assets, which people look at as treasury bonds, and it bids up the price, and it decimates the yield. And that's what we're seeing here. That's what we're seeing. It's no surprise to us, those of you who have been paying attention to this, and those of you who believe it, because this is just common sense. You don't need to be an economist to understand this. You don't need to be a hedge fund manager to understand this. You just need to look at reality. And watching the financial news every day ain't going to put you in that position to understand reality, because you have everybody and their mother getting on there to sell their book of business. Whatever stocks they own in their portfolio, they're trying to sell to you, for you to buy them, because they got in low and they want you to bid it up and get it up there higher so they make money. And a lot of these guys make money win or lose. And they are hoping that things stay the same. Take a look. Just do me a favor. And anybody can do this if you have the internet. Go to Yahoo Finance. Look at the S&P 500. Just click on the graphs there, and then just max it out. Look at the exponential growth that has existed just in the S&P over this last decade, compared to where its former highs were back in 2000 and 2007, 2008. Look at those peaks, and then look at the peak that we are today. Again, you don't need to be an economist to understand this. There is no way that is sustainable. The question is, when does it come down, and how far does it come down? That's the question. So prepare yourself. It's insanity. It's been a bubble upon bubble upon bubble. And now you have it here on Wednesday, the Federal Reserve coming out and saying, well, everything was great last year. Trump says we're in the best economy ever, but we can't raise interest rates. We cannot take the punch bowl away. We have a crutch, low interest rates. Our legs were busted. Everything was supposedly better. We're ready to run a marathon, ready to run the 100-meter. Take it away for a second and we can't walk. So evidently something's amiss. Something's amiss. It's either not the economic miracle or we're in a lot of trouble right now. Which is it? I think we're in a lot of trouble right now. I do. I mean, I applaud President Trump for a lot of the things he's doing. But get this. Politically speaking, because of the news that came out today, the Bob Mueller investigation is finished. It's wrapped up. His office turned over the report to our Attorney General, Bill Barr, and now that is going to be headline news for the next couple of weeks, maybe longer. Who knows? I mean, it took 2 years for this thing to get done. It might take 2 years for this to wrap up and be released to the public. I don't know. Hopefully sooner rather than later, so this country can begin a healing process, so we can get back to some sort of civilized society, some sort of humanity can get back into the process. I know I'm being optimistic, a little foolish of me, but I'm hoping. I'm an optimistic guy. I hope. Again, that's not the best strategy, but I hope that's the case. Let's bring some sanity back into this country. So here we have it. This is how this ties in, I believe, with the stock market. Remember, and I just advised everybody, especially if you were following over from the geopolitical report, I pointed this out. During the State of the Union address, President Trump told us the only things that can stop this economic miracle are endless wars, political partisanship, and endless partisan investigations into President Trump. basically making the case that the stock market loves the president. So if you continue with these pointless investigations for forever and ever, amen, the markets are going to crash, or they're just not going to like it. So here we have on Wednesday, the Federal Reserve comes out, continues its 180 policy, and I think even goes a little bit further and becomes more dovish than what the markets were anticipating. They do not foresee any future rate hikes this year, perhaps one next year into 2020. The quantitative tightening, the reduction of the Fed's balance sheet, is going to be coming to an end at the end of September. So we're told now. This is what we're told now. Again, how much can we trust them? 0%. 0%. Although I give it more weight that they're going to be more dovish than hawkish. That I can stick with. That I can understand because that's what they do. You know, if the only tool you have is a hammer, everything looks like a nail, right? They print money. That's what they do. So don't be surprised if there's a rate cut before another rate hike. But who knows? These people are making it up as they go. That's what's so sickening. That's what's so sickening. But anyways, President Trump came out, and like we had this conversation yesterday with Maria Bartiromo, which that interview was aired today on Friday. He's calling them out again. He is calling the Federal Reserve out again. We had 3.1% GDP growth when nobody said it could be done. I did. I told you it could be done. I said we could get 4 or 5. We would have had 4% if the Federal Reserve didn't increase interest rates as many times as they have since my tenure as President of the United States. So he's blaming them. He's blaming them. He is starting to send this message out loud and clear, especially to his base, that the Federal Reserve just ain't any good. Believe you me, this is what the president is doing. He is starting his messaging campaign against the Federal Reserve. On top of that, you have the Democrats already, even though this report has not been disseminated to the public yet, and it's not likely to be disseminated until at least next week at the earliest, because of course they did this on Friday into the weekend. I mean, this is how they do it. They try to keep it down, but you can't. Something like this, you can't keep it down. This is what everybody's been waiting for 2 years, if not 3. So you can't keep it down. This will be the headlines. But you're going to continue to see, and we already know this, the Democrats have come out tonight, and said, we're going to continue to investigate the man. We don't care what Bob Mueller says. Yeah, the president didn't fire him. Good. Bob Mueller could go in any direction he wanted, but maybe not all directions, and maybe he didn't go down every single rabbit hole to its nth degree, to its furthest degree. And so that's why we're here. That's why Adam Schiff is here in the House. He will continue. That's why Maxine Waters is there. She will continue. That's why Elijah Cummings and Jerry Nadler are there. They will continue. That's their job. Not to fix the infrastructure, not to get a more efficient tax code, really get rid of the income tax, but that's really being hopeful. Talk about the destruction of the Federal Reserve. Again, that's being hopeful, but we have the president who's hopefully doing that. Talk about infrastructure. Talk about bringing our troops home. Talk about peace and prosperity with Russia, with the Chinese, with Kim Jong-un, with everybody. But no, we can't do that. We can't focus on all those things. We can't walk and chew gum at the same time. We shouldn't even be investigating this president anymore, especially after what comes out in this report, because it's going to be nothing. It's a big nothing burger. You know it. I know it. Your mother knows it. That's just how it works. But everything is political because they despise our president of the United States, and it's sickening. It's sickening. But I told you the president was going to start doing his two-step, and there you have it. You had him with Maria Bartiromo. You had him telling us back at the State of the Union, and now you have a market sell-off. Will it continue is the question. That I can't tell you. But I do know that this market will return to fair value, and it is a long way down from where we sit right now. I wouldn't be surprised, this is my opinion, this is my analysis, that at the very least, if you look at the major indices, the ones I always talk about every show, the S&P, the Dow, the NASDAQ, and the Russell 2000, if you look at where the prices were back in 2016, I think at minimum that's where we're headed. Again, how long will it take us to get there? I don't know, but I believe at minimum that is the price level we will be getting to. I think it will overshoot. If you really want my honest opinion, and that's what I'm here for, I think we're going to go back to the 08-09 lows, maybe even further. Because when you have a crisis, you have to understand something. A negative shock it's disproportionate to a positive shock. So when something negative happens, people usually panic, really panic, especially the bigger the shock, right? So if there's a big panic, if there's something that really comes out of the woodwork, if there's one of the many catalysts that we talk about over and over again on this show, if one of those things really comes true and it starts a domino effect, it's going to be a huge panic. So it will probably overshoot fair value because that's what tends to happen. Just like to the upside, it overshoots based off of hope and sentiment and just people being optimistic. It overshoots to the upside as well. But typically, it does more so to the downside. So when you get to that point, and we have to be very vigilant, we are going to have the sell of a lifetime. You buy real estate when there's blood in the streets. You buy real estate when there's blood in the streets. You go where people don't want to go, and that's how you make your fortune. That's how you build your wealth. That's how you take care of yourself. That's how you take care of your family. That's how you pay for all of the things that you are passionate about, charities, whatever it is. That's how you do it. That's how you do it. You don't have to be joined at the hip. You don't have to be buddy-buddy with politicians or a crooked government. This is how you do it. This is how you do it. So stay vigilant, stay positive, stay focused. If you're somebody who doesn't like to sell the market short and time it, good. Don't do it. Don't do it because you can't time it. But if you're against selling the market short or don't know how to do it, don't do it. Build a cash position. Get your savings up. Get your debts paid up. And start building cash because it will be the sell of a lifetime whenever this thing comes down. Believe you me. Because whoever's left standing, well, they must be the cream of the crop. Buy them up with both fists. Buy them up with both fists and then just hold it and let it go because you are going to see these companies survive. They will thrive. And a lot of them, I'm sure, are going to be dividend players too. So you're going to collect a dividend on the way up. This is how you do it. This is how you do it. So just stick with me. Do not panic. Make up a plan. Stick with it. Stick with it. So getting back to the yield curve. Here we have it. The two main yield curves that people become fascinated with have to deal with the 10-year Treasury and the 2-year Treasury and the 10-year Treasury and the 3-month Treasury. Now, typically, this is going to get a little eggheady here, but typically the academics prefer to look at the 10-year minus the 3-month. And market practitioners tend to prefer to look at the 10 and 2-year. Regardless, you're looking at the same thing for the most part, okay? They have their arguments as to why they prefer one versus the other, of course. But if you get 10 experts in a room, you're going to get 10 different opinions. So there's no surprise there. But what do we have with the 10 and 3? Well, it inverted. It inverted, okay? It was able to bounce back a little bit, but we're there. We are there in that territory, which caused these markets to panic. The 10-year and the 2-year has yet to become inverted. But I imagine in the short term that it will. And once that happens, then that's really the final nail in the coffin, if you will, that something is coming, something is amiss here. Everybody's going to know it. It's just a question of, is it enough people that know it? And what starts happening? Does this start to become a self-fulfilling prophecy? Does selling beget more selling? Do people try to buy the dips? What happens? Again, that's all the market timing. That's all the market shenanigans. You can't predict that. You can't time it. So it's a fool's errand to try. But again, be aware that you are building a puzzle. And this is a very important piece to that puzzle. And it's starting to paint a more and more vivid picture. Now, if you're perceptive, if it's a 1,000-piece puzzle, once you have maybe, let's say 300 pieces put together, some people can say, oh, I know what that is. Or I have a really good idea of what it is. That's like you, the people who are listening to this podcast, because I know my audience is smart. And I know I'm smart when it comes to this stuff too. I'm not just going to pat myself on the back without experience. I say it because I've been able to be successful in the markets. I tell you all the time to take a look at the book, The Cynic's Guide to Investing, because we predicted this stuff. And now the other side of it is starting to come true. So you have to be aware. So when you're building that puzzle, some people can look at 300 pieces of the 1,000-piece puzzle and say, I know what it is, and you start to act. You start to take action. Some people don't know until there's 999 pieces there. And they're like, oh, yeah, now I know what it is. 999 pieces. Oh, it's a circus. It's the mountains. It's the Swiss Alps. Now I know what it is. Sometimes you pay a penalty for being too early, because if you get into the market, people still think, it's something completely different. And so you might get squeezed out of a certain position. But if you have a strategy that allows you to be patient and allows time to work for you, where you're not trying to time the market, well, once everybody realizes what the puzzle is that you knew at piece 300, you're going to make a windfall. It's just that simple. It's just that simple. But you have to be patient, and you have to have a stomach for further volatility. You have to be able to look at your account and maybe take a paper loss. And if you can't take it, then don't look at it. Just don't look at it. Set it and forget it, or just build up cash and wait for this thing to come down, and then buy the best companies that remain standing. That's what we have to do. You have to do it. Now, some of the news that came out, obviously the yield curve inversion was a big impetus for this major sell-off in the U.S. markets today, and the European as well. But there was some other news too. Again, not surprising to us. But get this. The U.S. posts the largest budget gap ever for February. I can't make this stuff up. I mean, it's just one negative story after the next. We're talking about $4.75 trillion budget for 2020. We're not even there yet. We're in 2019 here, and we have the largest budget gap ever for February. This is not the right direction. So that's not good for the markets. It's not good for the markets at all. We have, again, the yield curve inverting for the first time since 2007. We know this. And a glimmer of hope for those who remain hopeful. U.S. existing home sales beat forecast slightly. We have U.S. wholesale inventories rising the most in 15 months. This can go either way. You either have an increase in inventory because you have purchasing managers and businesses anticipating a healthy amount of demand, so they're just building inventories in anticipation of it, or nobody's buying anything. You get that? Those are pretty much your two options. So you think demand is going to be coming roaring back, or do you think, well, maybe people are starting to get the picture, they're starting to see more and more of the pieces of the puzzle, and they're cutting back? That would be my guess, but we're going to have to pay attention. U.S. private sector output growth slows in March. We knew this. U.S. factory growth, lowest since 2017. And we have the U.S. services activity growth easing further through the month of March. So it's one after the other. And the news out of Europe today was not any better. It was not any better. And we still have all of the Brexit shenanigans taking place over there too. We still have the merger, this great merger between Deutsche Bank and Commerzbank taking place. That could unfold with tens of thousands of employees potentially being let go. So that's not going to be good for anybody. Not good for anybody. Not to mention that those banks aren't in good shape. As standalone banks, they're not going to be any better together. It's going to be a huge Frankenstein, a huge zombie bank that we don't need to be dealing with. And that could be a catalyst. Mark my words on that too. So it's just one thing after the other. We're becoming used to this. What frustrates me to the nth degree is the fact that there is such a disconnect. These markets are going to whipsaw. We saw a 20% correction in the fourth quarter, and we have seen a V-shaped recovery ever since. There's only a few times in market history that we have seen this type of V-shaped recovery. And of course it comes after the fact when the president tweets buy the dip. I mean, is that just a coincidence? I don't think so. And that ain't right either. So there's a lot to pay attention to. Stay cool, keep calm, pay attention. Get a plan together. Get into what you know. Don't go out on a limb and start investing or trying to time this market and do things that you're uncomfortable doing and things that you don't understand, because you'll get whacked right over the head with a frying pan. Do not do it. Stick with what you know. If you don't know the other side of the trades of selling short and all that stuff, again, build up a cash position. Wait for this thing to unravel, because the companies that stand up and survive this thing are going to be the best of the best. Buy them with both hands and do not hesitate. Do not hesitate, because that is how you are going to change your life and the life of your family, because you're just going to own the best companies. It's what you have to do. Use your head. Buy real estate when there's blood in the streets. All right, everybody, thank you so much for joining me. It's been a pleasure having you as always. It's already Friday. Enjoy your weekend. We'll catch you next time back here on Monday. This is the Capital News. I am Alex Koritis. Godspeed.